Many have heard the phrase, it will be better next year, or we'll spend the money next year. I'm looking forward to the long term of agriculture. Things like that. But the big question, is it true? Will it be better next year? Is farming making more money than it previously did, or less? I explored this topic on my second channel previously, but thought we would do a more deep dive here on the main channel. In the excavation industry, we would shoot for 50% profit, meaning whatever the cost of labor, the cost to cover the job, materials, fuel, etc., those costs were X, and we tried to make 50% more than X. Now that may seem like a lot, but when compared to other retailers such as Walmart or even your auto parts store, which have well over 100% markups, it's not. When we would check profit margins, it would drop as low as 30 to 35%. We began to really notice it in our pocketbook, our ability for expansion, or even to buy or expand machinery or machinery payments. So we always aimed for that 40 with goals of hitting 50% profit margin. And even though it was a break-even business, that percentage of profit margin allowed us to buy the machinery that we had. On the farm, things are different, and that's because we produce commodity versus being a service industry. A wholesale commodity market is not influenced by the producer, although then again it is. Whereas a service industry, oftentimes the costs are passed on to the consumer. Commodities markets react to supply and demand, and oftentimes have a lasting tail. How many of you have heard Challenge 2050? If you have not, what Challenge 2050 is the challenge to feed, supply, fuel, energy, everything the world needs by the year 2050, when they believe population will reach an all-time high. Although that's not totally predictable, and we are starting to see a flattening, the world population still is increasing. Each year, urban sprawl and other factors take agricultural land out of production, but technologies continue to increase yield goals, and other countries are coming online with more technological advanced farming practices. The world's second largest corn producer, China, recognized their population growth a few years ago. They recognized the need to feed everyone, so they began exploring options. One of the options at the time, when I saw it myself on the internet, was Chinese buyers interested in buying farmland to ensure the Chinese people have adequate supply of food. That's a controversial subject, but the takeaway for this video would be the global market. As you produce more in other countries, that lowers our export requirements. It drops demand. When you combine other factors such as the war in Ukraine, which would be a loss of production, that it increases need for export. And combine that with worldwide drought, that's where you have supply and demand and market waves. ISU keeps a complete record of all commodity prices throughout history. I believe these are future prices, and they're not tallied daily, they're averaged over the month, but they keep them throughout the course of history. You can download all this free off the ISU website for yourself. As you can see on that chart, markets go up and down. But if you have a low point and then a high point, and you draw a line through the center of this, you just draw a straight line. What that line is the average. When I was analyzing corn, I did a 5, 10, and 15 year average. Now the overall curve of that average was in a decline because the 5-year average was less than the 10, and ironically I backed it out to a 15 year. So from 2021, count backwards 10 years, the average price for corn was $4.35. Starting at the year 2021, going back 15 years, the overall average was also $4.35. Now, if you go backwards only 5 years, and the average is in the threes, to return to that 435 line, we will need to be in an upswing. The big topic of inflation right now, but in the news, they often speak about commodities. But is inflation the sole reason commodities have went up? In corn and wheat, we've hit new records, although I can't confirm that soybeans have. But is it really all that high? That's where I went to an online inflation calculator to see our increase of our dollar, or I should say devaluation of currency. And you can see here on your screen the year that I compared it to, which was 2022 compared to years previous, and what $1 now would be worth in comparison. I believe corn went to a high of $6.90 or $6.92, which bumped or possibly exceeded the old record. But considering that record was set in 2013, have we really, or I should say, do we really have that high of prices in commodities? According to an inflation calculator in 2013 of $6.90 corn, that would put us at a current of $8.79. So realistically, based on what our dollar's worth, corn is still selling fairly conservative. And it was interesting to go back all the way to the year 1913, which is where the calculator starts, to see just how our dollars changed. The next step I took was seeing how yields compare with revenue. I compared a current 5-year average scenario versus a 1970s 5-year average scenario and like a 1920s 5-year average scenario. Then I went back and adjusted to the yields, which the ISU website also keeps yield history. And if you convert the yield for what we're getting per bushel, and convert that on an inflation calculator, over time per acre, we are making a smaller and smaller percentage of profit. In the late 70s, a brand new John Deere 4430 was around $16,000 to $17,000 depending on options, and that was your cash price to take it home. As you can see here, if you go to the inflation calculator, 1977 to 2022, that would put that tractor at about $78,300 currently if it was still being manufactured, and that's figuring rate of inflation. I then went to johndeere.com and built and priced a 6155M, which would be the modern day equivalent of a 4430. This is the only tractor I could find that had a similar engine, similar technology, similar hydraulics, two-wheel drive platform with similar tire size, and same gear range transmission. After finalizing the build configuration and taking a list, converting it to a cash price, that tractor was going to be around $135,000 to $140,000. So as you can see, even though the tractor has not changed much, the cash price has. I also pulled a 9430 John Deere 4-wheel drive 425 horsepower tractor quote from my file cabinet. The cash price on that tractor in 2010 was $245,000, which the nearest tractor made to that now is a 9R440. Again, not a dramatic increase of anything, and including it's an identical frame, but the cash price on the new 9R440 is probably going to be around $450,000. So even over the last 10 years, tractors have more than doubled in cash price, although some technologies have increased those prices. While all farmers are in the same boat, many are different at the same time, meaning that some rent a majority of their acres while others own almost all their acres. Some have paid for older equipment, some like to lease newer equipment. Just every single business or every single family operation or personal operation, however it's directed, however it's set up, is different. Therefore, no two farms will have the same financial outlook. But at the same time, when you compare commodity prices over 20-year averages, which commodities don't move a lot over larger periods of time, and compare that with the price of inputs, equipment, and other things, we're all in the same category, in the same boat. The point of the CRP program was to help with prices. CRP is also known as set-aside acres. It's essentially where farmers plant the fields of grass and set the field aside. In turn, the government pays you every year for doing the program. This has also been a controversial program, but it is a clear answer to solving farm crisis. Before leaving office, Colin Peterson introduced a bill to put CRP at 50 million acres. CRP is always around 20 million acres per year, but we are also suffering record low prices over the last 5 years. So Colin Peterson introduced the idea of getting up to 50 million acres, which would cause commodities to increase in price. Again, supply and demand. Less product being produced, with demand for the product, means a higher price. As I said earlier in the video, farmers cannot control the price of their commodities, but then again they can. If every farmer in the United States set 10% of their acres aside voluntarily, the price of grain would likely go up. But because we're all in competition with each other, no farmer is going to do that. In fact, most are looking for ways of producing more so they can beat out the next person or get more income for themselves. Now, for hypothetical conversation, could you imagine if there was only 3 farmers in the entire United States? Do you suppose that if all 3 knew each other, liked each other, and cooperated with each other, that there would be the ability to control prices? I'm sure there would. It's also that the same thought process and mentality that goes into the corporations supplying seed, equipment, and other things for farmers as to why we pay the prices for it that we do. And a lot of what we get for our commodity or our livestock is also controlled again by that same process. As to why commodities are record high right now is due in part to what I just showed with the 50 million acres. We didn't get 50 million acres of CRP, but we continuously have about 20 million acres enrolled in CRP. But what we did have is a derecho one year. There went 20 million acres. The year previous, I think in 2019, there was 23 million acres of preventative due to flooding. So 20 million acres of derecho, 20 million acres of CRP, there's real close to your 50 million acres of set aside. Prevent plant and continuous CRP, there's real close to your acres of set aside. That results in ending stocks and production numbers being to where they are as to why commodities have skyrocketed. Another issue is drought, worldwide drought, primarily for the 2022 year in the Northern Hemisphere. And we saw that big time on our farm, being almost 12 inches of rain below average for the year 2022 so far. And the Kansas dry line is moving closer to western Iowa. So I wonder if it will become a more often occurring theme in years to come. Time will tell. In 2021, we had a great crop. A lot of people had a really good crop, and there was a large crop carryover. Now, short crops have long tails. So 2022, a drought year, will have no crop, but it may be later into 2023 until we start to see that as 2021 crop carries over the calendar year into 2023 as well. You produce the crop in 22, it gets sold in 23, and oftentimes will be used up and finalized by 2024. That's how it works. So there's always a lag time in how the markets will respond or react. But it's my firm belief with the drought combined with the previous losses that we'll see even higher markets than we've previously seen. But then again, if you compare that over the averages, it's probably not out of range high. And don't forget about that 5-year curve. At some point, it's going to go into a decline, and that'll be due to good weather or other factors. In a typical farmer fashion, including ourselves, because of these higher prices, everybody's out there to get what they can get while they can get it, which usually leads to overproduction. It's in my opinion, we're in about year 2 to 3 of a 5-year upswing, so it's a good time to get the things done that you want done, so pending that you had a crop or have the ability to. I'm glad I've been able to do the things that we do on our farm, but at the same time I'm a little frustrated as we entered into a drought year here, combined with the price of inputs just skyrocketing through the roof. So we know that it'll be yet again another year where you really don't generate the profit margins that you'd like, although we are paying for a lot of things and we're getting some really nice equipment and stuff that'll be paid for at the end of that 5-year span. And that was the goal when initially looking at going this direction. An ideal situation in any commodities market would be more of a flat line instead of riding the wave, as a flat line provides a more equal chance opportunity, and you kind of know where you're at a long time. It would be equivalent to anybody working a job and getting a continuous $15 an hour versus $7 an hour one day and $135 an hour the next day, then followed by possibly no job the following week. One problem that all farmers face, again where we're in the same boat, is essentially how to keep that money. If you make an income, you may not want to make an income, because many people that are conservative minded and don't want to spend any money would like to keep the money that they have. But this is where tax code comes into play. Generally speaking, most ag bankers will allow you approximately 50% debt. So if you own $1 million of total equity, they'll let you borrow $500,000. Essentially, you can pay for half of it. A farmer that does not want to sell all of his commodities, or maybe does sell all of his commodities but just wants to keep the money, if you do that and you show an income, you do not have any depreciation or anything to deduct, you end up writing a check to the government. That's where we all are in the same boat. But the one thing we can do to get out of this is pay interest or depreciation. So that forces us to buy things like we're looking at, equipment, or you end up going out and you borrow money or borrow against your farm and you stay in debt, which when you have debt is the creation of money. What you guys are looking at here is just a standard online calculator. This one's from farmcredit.com, and there's many others out there. It's an amortization calculator, which is basically paying for a mortgage, and you can plug in your own figure. The takeaway here is the amortization schedule. If you notice around that year 7 to 10, the interest and the principal amounts start to flip-flop. All interest up front, then it becomes more principal later. That way the bank gets back what they need to make quicker. Interest is also tax deductible. If your financial IQ allows you to paint the bigger picture here, utilizing debt can be positive for business rate growth expansion, as the only thing that really matters in bank stress is cash flow, which cash flow is nothing more than a term to say that you have enough money at all times to cover your bills. Doesn't mean profit, it just means covering your bills. Therefore, any farmer who has the ability to can go out, refinance, redo their debt, take on new debts, and show a continuous rate of growth. And that's even with commodities staying in that regular 435 curve. But these are all formulas that work together that you want to be aware of before going into something like this, as there are good debts and there are bad debts. And you also have to do what defines you. Some people are just not comfortable taking on those kind of risks, but at the same time get left out or maybe looked down upon others that did. So it's all about timing, it's all about the risk assessment, it's all about your personal comfort level, your character, and how well you can figure out markets and your ability to control certain things. And that's why farmers, again, are all in the same boat, but much different at the same time. Now, this tax code and tax deductions versus the generation of money are a little too coincidental, in my opinion. But obviously, it's geared that way to keep people that are established just that, established. Anybody young, such as myself, wanting to start from scratch at zero, getting into farming, or being able to start a farming career, buy land, it pretty much just casts those people aside to make sure that it keeps them down and out. This same mentality leads to wealth gap separations and a decline of our society, at least in my opinion. I often get asked on this channel, is there any hope for a young farmer to get started? Which my reply in the comments is usually no. That's not to be cruel, that's just to have an honest answer. It would be tough at best, and require supplemental income. Now, if you're an established farmer, there are things in the future coming up, such as this, what you're seeing here on the screen, Fuel the Crush program, which could be big. It's your carbonless fuels. In order to keep the world turning and keep an increasing population fed, clothed, and sheltered, the need for certain things, such as energy, are skyrocketing. And one of those energies is fuel. The carbonless fuel thing, I think, will take off. I think it's going to be something here to come for years to come, as well as increase of ethanol, which we saw that with the year-round, the E15, as well as Boeing and other companies are starting to work on essentially ethanol-fueled aircraft. That could be huge. So the need for it is increasing. Yields are somewhat topped out, and again, we are facing drought, or I should say a new dry line. So like everything, things change. Time will tell how it will pan out. But I do think if you're established, there is opportunity in the future, although as the numbers have proven, the opportunities in the future or current have not been what they were years previous, and I firmly believe that's to a devaluation of our currency. I hope you enjoyed the data in this video. Feel free to drop in the comments below what you think the future of agriculture will or won't be, and stay tuned for what things I talked about here and how we're going to implement them, our own operation going forward into the future. Now, since this video will probably get marked as a little bit controversial, I'm going to ask you guys one question to conclude the video. And with 2004 to 2013, we saw the ethanol boom. And the reason we saw the ethanol boom was post 9/11 was the idea to decrease the need for foreign dependence of oil. But the North American Grocers Association raised hell, saying that the price of commodities was the sole reason that your groceries are going up at the store. Now, if you go back to 2012 and that corn hit about a peak, you can see what the conversion was to modern day. Look at the price of a box of mini wheats. Go buy a box of mini wheat cereal. Then go Google what the CEO of Kellogg's is currently getting. Now go buy you a box of mini wheats right now, and go buy you one, or have you had bought one 4 years ago. My point is here, commodities increased, the price went up, then commodities fell flat on their face. It went to about $2.80. On corn, wheat was $3 to $4, but that price of mini wheats stayed at the previous price of the high commodities. Now we went up in commodities again. The price will go up, but in about 4 to 5 years from now, when the price of commodities really starts to decline, which I'm sure it will, tell me what that price of a box of mini wheats does then.